All right, good morning, everyone, and welcome to Startup Week. My name is Keith Bowers. I'm the Regional Director at the Small Business Development Center at Florida A&M University, and today's series, Donuts and Dollars. So I hope you all had a chance to grab some donuts. They're provided by Donut Kingdom, one of our local small businesses. And today we're going to talk about how to build a bankable business. And before we get into the details of the presentation, I do want to just kind of give you an overview of some of the services that we provide. At the Small Business Development Center at Florida A&M, we provide consulting services and technical assistance to small business owners and entrepreneurs. And we pretty much categorize our clients in two separate distinct categories. One would be emerging businesses, and these are businesses that are anywhere between 0 to 3 years old. And it could be folks that are coming in with ideas or may have gotten started, but again, they haven't been in existence for more than 3 years. So the types of services we provide for them, we help them with business health checks, feasibility studies, financial analysis. We do a lot of work around market research because again, these businesses are really trying to find their way and they need some intel on what the market demands are. And so we provide a lot of in-depth resources for market research. We also assist them in securing capital. They might need funds to get started, for inventory, to onboard new folks, to buy equipment, those types of things. We help them secure capital. And then for us, the rubber really hits the road with the individual consultants. We have 6 certified business consultants that work at the Small Business Development Center, and they all have varying backgrounds, ranging from finance to accounting, management, marketing. So we have an array of talent that's there to be used and leveraged as a resource. We also provide workshops and trainings, and we help with business plan reviews. For our second target market, which are the more seasoned businesses, these are businesses that have been around at least 3 years, have at least 5 employees, and about $500,000 in annual revenue. We provide a little bit more in-depth services for them and assistance. We help with cash flow management. We still think it's important to do the financial analysis. We help with access to capital. If they're interested in any type of government procurement or corporate procurement opportunities, we help them prepare for that. We do business valuations. So if you want to know what your business is valued at, we have certified business valuation specialist that works here at the Small Business Development Center. And then in terms of market diversification, one thing that the COVID pandemic has shown us is that businesses, whether you're small or medium-sized businesses, you need to be nimble. So when those opportunities that you relied on once before start to dry up, it's time to start looking for other ways to generate revenue and sustain their business. So we help them do a deep dive into areas of opportunities for market diversification. We help with strategic business planning, and for those businesses that have a website, we do website audits to make sure it's optimized for search engines. And for those businesses that don't have websites, we contract out with a couple of local firms to help them build websites. And again, these are all services that are available. And one thing I forgot to mention, the most important thing is these services are provided at no cost. We are funded by the Small Business Administration, Florida Legislature, and Florida A&M University. So these services are provided for free to our clients. All right, so let's get into it. Is your business bankable? And that is very important because my background is in banking and finance. I'm a recovering banker, worked in the industry for, as soon as I got out of college, I went to work at a commercial bank and was a loan officer. Worked SBA loans and then conventional loans. And what I learned over time is that a lot of small businesses were primarily not bankable. I couldn't make a positive recommendation for a lot of the applications I received. And then we'll unpack a lot of that and kind of get into the reasons why. But the most important part is, what I want you to walk away from this morning's session is understanding, how to make your business bankable. So when we start looking at statistics, small business loan approval rates, institutional lenders approve 23, a little better than 23% of the applications they receive. Big banks, even less, 13.3%. Small banks do a decent job. They're at 18.2%. Credit unions, a little better at 20.3%. And then alternative lenders. These are folks that are not conventional lenders. You may think of folks like Cabbage as an alternative lender. They don't necessarily have a brick and mortar presence, but they do loan money to small businesses. And they are a little bit more aggressive, and they're right at about 24%. But still, when you look at these statistics, you would think that they would be higher because we have a lot of small businesses out there. So, it's a struggle. Access to capital has always been a struggle for small businesses. And I'm going to give you some insight as to ways that you can help improve your chances of getting yes in your platform. So, what are loan officers looking for? Again, when I was a loan officer, we had regulated for one. So our decisions had to sort of fall into a certain level of we're basically doing a risk analysis. We take a look at a lot of different things and we determine if that's a risk that the bank is willing to take. And it's not my money. I'm lending the depositors money. So I better do a good job of analyzing that risk. So I'll walk through with you today what banks are looking for, what loan officers are looking for. First and foremost, they want to see that you have a business plan. And they want to make sure that your idea is not just in your head. It needs to be in a format in which they can review it, because oftentimes they're not making the loan decision. The loan officer is not making the loan decision. They have to, depending on the loan amount, they have to take it to a loan committee. So one of the things that you need to make sure is that you have a written business plan. Whether you're a startup business or an existing business, you need to have a written business plan. And it should show how your business will operate profitably. And so we'll unpack a little bit of what goes into a business plan. So if you're an existing business, let's just say you've been in business for 3 years. They're not looking for you to start from scratch and writing a business plan. What they want to do is look at what you have done over that 3-year period and provide an executive summary. So it's not a fully involved, in-depth business plan. So what they want to see is they want an overview of your company. They want a description of the market in which you provide products or services. They want to understand what your capacity is, in terms of manpower, resources, equipment. They really want to take a deep dive into seeing, is this a business that can grow over time? And then they want to understand, if we loan you funds, how will those funds be used? What are you going to use those funds for? Are you going to consolidate debt? Are you looking to expand into a different market or go into another service area? Are you going to purchase assets? Are you going to use it for working capital? So these are, again, if you're an existing business, you should start with an executive summary when you approach a loan officer. Because again, he wants to understand, or she wants to understand exactly what your business is all about and how you plan to use the funds. Now, if you're a startup, it's going to require a little bit more work because you don't have a track record. And all these ideas and concepts have not been proven in terms of just being out there and accepted in the marketplace. So they want a little bit more in-depth information from you. So a full business plan will consist of a executive summary, company description, a market analysis. And so when we start talking about market analysis, let's just say we're going to start a IT consulting company. And they want to know, when we talk about market analysis, we want to understand who your competitors are, right? How many other folks are out there that you will be competing against? Do you have any potential customers that have indicated that if you got started, they would do business with you? They want to understand, is this in terms of a 30,000-foot view of this industry, is it a growing industry? Is there a lot of demand for the services that you plan to provide? So they really want an in-depth analysis. They want a description of the management. Who is going to run the company? And what are your credentials? What are your backgrounds? What are your expertise? Because, at the end of the day, the business has to be run by someone. And one thing that I find that in a lot of folks that we see, people want to start restaurants. And they tell me, Keith, I really want to start a restaurant, but I've never run a restaurant before. My friends and family tell me I'm a good cook. So, I'm thinking I might, test the waters and start a restaurant. And I always ask them, how much do you charge your friends and family? And they say, well, I don't charge my friends and family. So what I'm getting at is that, being a good cook and running a restaurant are two different things, right? You could be a great cook, but in terms of just managing the logistics of running a restaurant, you really want to make sure that you have some expertise in that. And that's what loan officers, financial institutions will be looking for. They want to understand what products and services you provide and how you plan to penetrate the market, because it is a very crowded marketplace. So they want to make sure that you've got a solid marketing plan, because you're going to be competing with folks that are already up and running. So what is your plan to introduce yourself and create visibility around your specific business? They will also want to understand your sales strategy. How do you plan to target your customers? What is your unique selling proposition? What are you going to do better, cheaper, or more efficiently than those folks that are already out there that are established and conducting business in the space that you plan to? The funding request, again, they want to understand what you're going to use the funds for, and then they want to see your financial projections. So they want to understand how much revenue you plan to generate and what are the expenses that you're going to incur while you're generating that revenue. And at the end of the day, they want to make sure that there's enough after you subtract your expenses from your revenue, that there's enough to sustain your business and, more importantly, pay the loan back. So those are the things that go into a business plan. And again, financial institutions definitely want to see that. I work with several financial institutions. In fact, they call us and say, hey, we've got a client who has an idea, but they don't have a business plan. So we need your assistance in helping them put together a business plan. The next thing that they want to make sure is that you have skin in the game. They want to make sure that you are putting something at risk as well. It's very, very rare that a financial institution is going to loan you 100% of what your projected needs are. Again, they want to make sure that if something goes south, you just don't walk away and have them. So what they typically look for is, in most cases, that you have at least 20% of the total project costs. And we'll talk about the different ways that we can come up with that 20%. But again, they want to make sure that you have something at risk. So if you have a bad day or a bad week or a bad month, you just don't put your hands up and say, I tried it, forget about it. If you have placed $50,000 in that, the likelihood of you having a bad day and walking away from it are greatly reduced, right? So again, and one thing that when we talk to entrepreneurs, I ask them that question. It's a hard question. So what are you willing to put on the line? What are you willing to risk? And at the end of the day, if you're not willing to bet on yourself, why should someone else, right? So you just have to get comfortable with that, knowing that you're going to have some skin in the game. So the different forms of equity injection, we call skin in the game. equity injection. Could be cash, so it could come from your savings. Or of late, folks have been, especially after COVID, people have been transitioning out of the workforce and starting their businesses. And what they're using is their 401k savings. Some folks are borrowing money against the equity that they have in their home and using that as their source of equity injection. So cash is one form of equity injection, and then collateral is another form of equity injection. So if you have purchased equipment, or if you own real estate, you have commercial property, those types of things could be used as collateral or forms of your equity injection. Okay. The next thing that's important that banks are looking for is clean credit. You want to make sure that your credit is clean. It does not have to be perfect, but they want to make sure that you have a decent credit score. We won't talk about numbers, but because it varies from financial institutions, it just varies, and also on the different types of programs that are out there. But what they're looking for is that you have a good credit rating, which means that you have fulfilled your obligations in the past. Because the past, how you perform in the past is a great predictor of how you're going to perform in the future. So you want to make sure that you have a solid credit history. And if you have dings on your credit, if there's, you run into some hiccups, if you have a rough patch, and your credit took a hit, be upfront and tell the loan officer that going into that application process. Because if you don't, and they pull your credit and find out that there are some things that you weren't completely transparent about, you got two problems there. You got a problem with your credit history, and then you also have a problem with your character. Because as a loan officer, I hated surprises. When people have these grandiose ideas, and they talk about, what they've been able to do, and I ask them, well, how's your credit? And they say, oh yeah, keep my credit is good. And then we pull that report and it comes back. And it's not. I'm thinking to myself, what else might not be as advertised? So make sure that you're upfront and candid and transparent as it relates to credit. So let me give you some tips about credit. There are three major credit reporting agencies: Experian, Equifax, and TransUnion. I would suggest, if you're planning to try to secure funding for your business, I would go ahead and obtain copies of all three credit reports. With all three credit reports, and review them and determine if the information contained on the credit report is accurate. Because people make mistakes, companies make mistakes. So just make sure that your credit report is things that are being reported are accurate. If you have any negative items that occur on your credit report, I would provide a written statement explaining why, what happened. And that, believe it or not, goes a long way. Because, bad things happen to good people. But if you're able to document that and explain it, then that puts you in a better position. And again, you're telling that loan officer up front, I ran into a rough patch, here's what happened, putting this stuff in writing, it's all verifiable, and that helps. If you're an existing business and you have established lines, okay, and it could be with your vendors or your suppliers, you could possibly would have a Dun & Bradstreet, Equifax, or Experian. So personal credit is one thing. We're always going to look at personal credit because at the end of the day, they're looking to a warm body to guarantee this loan. And then they also consider if you are an established business and have lines that are open, they also will take a look to see how your business credit is. So, and I would say review your credit reports on a regular basis because a couple of things, especially in the last 5 years, they've seen a rash of identity theft. So you don't want any surprises either when you get a copy of your credit report and realize that someone has stolen your identity and it's taken out some credit cards and have not paid them. So I would review your credit on a regular basis. So we talked about business plan. We talked about the skin in the game. We talked about credit. Right? The next thing that financial institutions are looking for, they want to make sure that you have accurate financial records. So when reviewing loan applications for businesses, what they want to see is that you have tax returns that indicate your earnings, your expenses, and your net income, and you're filing that with the IRS. They typically will ask you for 2 to 3 years of tax returns, and then they also want an interim statement. So today is November 10th. So if we were applying today, they would want to see your year-to-date from January 2021 probably to October. So they want to see, how well your business has performed over the last 10 months, in addition to those 2 to 3 years tax returns. And what loan officers are looking for, they're looking for trends in your revenue. They're looking for trends in your expenses. They want to see how profitable the company has been over a certain period of time. And this is all information that they will use to support your loan request. So they want to make sure, again, that your business has a financial history to repay the loan at the end of the day. So it's important that you maintain good financial records. Now, one thing that I will tell you is because some small businesses don't have an accountant, and some small businesses are relying on play out during the COVID when paycheck protection loans. The banks will require that you provide them financial statements, and quite frankly, that's what stalled a lot of small businesses for getting in line for these funds. So my recommendation is that you get a bookkeeper or an accountant. If you can't afford a bookkeeper or an accountant, I would say invest in an accounting system such as QuickBooks or Quicken or Xero, and start to keep track of your revenue and your expenses. Because this is what the financial institutions are using to determine the financial health of your business. So we'll talk about some essential financial statements that loan officers are looking for. These are your tax returns, like I talked about. They're probably going to want to see your last 2 years tax returns. And let me stick a pin in that also, because I think this is important. One of the things that I experienced when I was a loan officer, some of my more established clients would come in and they would turn in their tax returns and they would show a loss, right? And I'm like, well, how are you gonna repay me if you got your bottom line is in the red? And then they would tell me, well, Keith, I really make this amount, but I don't want to have to pay taxes. So I'm understating my earnings because I want to reduce my tax liability. And I can't go to the loan committee with a wink and a nod saying, well, this guy he really makes X amount. At that time, we could only report on what you have. We could only make recommendations on what you have reported on your tax returns. So what I tell my clients is, when you start your business, you've got a not so solid partner called the IRS. Okay? You have to pay them. You have to pay them, and you need to be accurate. And I know a lot of accounting firms will kind of help you, work through all of the things to reduce your tax liability. But I wouldn't be too aggressive, especially if you're planning to borrow funds. Because at the end of the day, you want to be able to show that your company is profitable. So the next thing we talked about a little bit was that interim profit and loss statement. Being able to show where you are year to date. And then also, if your business is seasonal, that's really important too. Here in Tallahassee, it's a college town, so a lot of service industries are very seasonal. So, some months it's very, very slow, some months are very, very hot. So having that historical information and year to date, when you can basically point to those ebbs and flows, is going to be important. So make sure that you're able to produce a profit and loss statement. You also need to be able to produce a balance sheet, which basically shows your assets and your liabilities and the equity that you have in your company. So make sure that you're able to produce a balance sheet, because that's important as well. And then end of the year profit and loss statements and balance sheets are all used as part of the application process and supporting documentation that you would submit. And then loan officers want to see a debt schedule. So they want to see if you've got any existing debt, who do you owe, how much are you paying on a monthly basis, and what's the balance of that. So those are the essential financial statements. We also looked at cash flow, going into more in depth, looking at your cash flow statement. So they want to see, how frequently funds are coming into your business and how frequently funds are leaving your business. And then personal financial statements is another essential document that loan officers will require. And your personal financial statements outside of your business, separate from your business, they're looking at you. Because again, you are the warm body that is guaranteeing this loan. So they want to see, what your assets are, what your personal assets are, what your personal liability is, and what your net worth is. So they require that you complete a personal financial statement. And then projections. So if we're looking to expand, we're an existing business and we're looking to expand, they want to see, well, what does this expansion look like? If we do expand, how much additional revenue is it going to generate? How much additional expenses will that expansion require? And then at the end of the day, how much is left on our net profit? So for projections, what most financial institutions are looking for is at least 3-year projections. So, and we can help you with those projections. We do it on a daily basis with our clients. We help you build those projections. We look and analyze what they have done historically, because that's a good indicator of how they're going to perform. We make certain assumptions. And what I tell our clients is no one has a crystal ball. So a lot of these projections are really going to be based on market analysis and what you've done historically and what your competitors are doing. And we have the resources to pull that information, aggregate that data, and help you build projections for your company. Mm-hmm. Now, the debt service coverage ratio is probably, I won't say probably, it is the most important portion of the analysis that goes into play when you're applying for a loan. Because as a loan officer, what my number one job was to make sure at the end of the day, the loan got repaid. So that's what I'm focusing on. That's what I'm honing in. And so when you start looking at the debt coverage ratio, it tells you basically when you have your net income, after you start with your revenue, you subtract your expenses, and then you have your net income. And with that net income, how much of that net income is going to be required to cover the monthly loan payments that you've applied for? So there's a formula to calculate that. And it is net operating income divided by your business debt payments. And it gives you a ratio. And we're going to talk about that and give you an example. So let's just say a company has a average monthly net income of $6,000, and their monthly debt payments are $4,800. So based on those numbers, the debt service coverage ratio is 1.25. So if you were to divide $6,000 by $4,800, you would get 1.25, which means that you can service all your monthly debt and still have a cushion, right? You got 25% of that $6,000 as a cushion. And they don't want, loan officers and banks don't want to see that you're cutting it to the no. Or they want to make sure that if any contingencies occur, you have some additional funds, and making that loan payment is not going to impair your operations. So that is how we look at it. And then we'll just walk through another example. Let's say you get average monthly net income. And in this case, we're looking at, we're going to expand our services. Now we're going to go from $6,000 to $8,000 based on our expansion in terms of revenue. And now our current monthly proposed debt, we still have that existing $4,800. But with this new loan, we're taking on, our monthly payment is going to be $1,200 a month. So what we would do is we would add $1,200 to the existing that $6,000 of monthly debt. But now our average monthly income is $8,000. We got a projected net service coverage ratio of 1.33. So we can service that $6,000 debt, and we still have 33% of this $8,000 to handle any other contingencies. And so again, we're not just running it right to the margin, right to the edge. We do have some funds where we can operate. So the fifth thing that financial institutions are looking for is experience. And we talked about this a little bit earlier, but lenders really want to examine, is this the right interest review? What is the track record in this industry? You have a track record in this industry. If you don't, chances are you're not going to get too far with the financial institution. They want to see that if you're making a transition, and I'll give you a prime example. We have a lot of folks that, especially in the construction industry, that let's just say the landscaper, guy who wants to start a landscaping company. And even though he is planning to start a new venture, he can say, well, I've worked for ABC Lawn Care 12 years. And not only did I work for 12 years, but I managed to recruit for 5 of those 12 years. So now he's got experience, and that makes it a lot easier. So he's aware of what it takes to run that business. He knows what equipment is needed. He knows how to get out there and market, and advertise, get new clients, and he knows that he knows how he should be operating profitably. But if you're going into a new venture, there's just so many unknowns, and financial institutions aren't willing to roll the dice on learning very quickly. So it just helps you if you've got experience, and that is one thing that they look for. And again, it helps if it's in that specific industry. Now, given that same scenario, if my landscaping guy says, hey, now what I want to do is go operate a hair salon, I'm scratching my head like, where's this coming from? What experience do you have in operating a hair salon? This is a completely different industry. And again, it's the risk level that the loan officers and financial institutions are assessing in making these decisions. Now, there are different ways for you to document your experience. Obviously, you can provide a resume that sort of outlines what your experience has been in that industry. You can provide references. So if you have folks that you have worked with and had a good positive experience with, you can provide the loan officer with reference letters to help you document that you've got the requisite experience. And then I always advise our clients to include all this information as part of your business plan. Other things that are sort of like unconventional ways to document your experience would be any publications or newsletters or anything to show that you are a real company, a real entity, what other people are saying about you. One thing that is trending now, where loan officers are looking at your LinkedIn profile, right? So if you come and borrow money, they'll probably also look at your Facebook profile, but they're going to pay more attention to your LinkedIn profile, because that is where you are basically, putting out your professional credentials. And then the other thing that they like about LinkedIn are the endorsements, right? So when you have a LinkedIn profile, you invite people to endorse that you are an expert or certified or have experience. They look for that. And so that also helps. And then if you're an existing company, they will also look at your website. They want to see that you've got a website. In your website, you've got testimonials, you've got a team. There's a segment, with the About Us that talks about, the history of your company. So these are all different ways to document that you have experience. So, number 6, very important that you build a good relationship with your loan officer. And I would say, having that relationship is just like having another partner, because if that relationship is managed correctly, they will become your business partners. Banks are in the business of making loans. That's how they make money. So they view you as, one of their key clients. And so establishing that relationship and that rapport is essential. And I would say, the only time, don't think the only time that you contact your loan officer is when you're ready to borrow money. Most successful entrepreneurs, they stay in touch with their loan officer just to keep them apprised of what they're doing. Call and ask them questions. So I'm thinking about doing this. What's your thoughts on that? But having a good relationship with the loan officer is essential, because they are your advocates, right? So when you do come and approach them, they won't have to, try to build a case for an approval. They can say, well, yeah, this person has been working, we've been working with this person, they expanded over the last 5 years, they've gone from 15 employees to 20, whatever anecdotal information that can be provided just from your conversations that you have with your loan officer can be very, very helpful. So here's some tips on relationships with lenders. Again, I can't stress it enough. Be very transparent with your loan officer. If you're running into any financial issues, don't make it, don't call them after you've missed your payment. Call them when you think it's going to be a problem when you make your payment. And sometimes they are willing to work with you, but let them know of any adverse issues that you're having. And again, avoiding them makes it even worse. That's why one of the things when I was, and I was a loan officer at a small community bank, and we didn't have a collections department. So the loan officers had to collect the loans that they made. And that was one of the worst parts of my job. We had a list of folks that I had to call to have to make their payments. And I would say maybe 10% of the folks returned my call. So I ended up having to chase them, and I'm like, no, you're here. Let's see my number, and sending letters and phone calls and stopping by your office, and they're just so dark. So that puts me in a bad position, because I can't advocate for them if I don't know what's going on, and if they're not forthcoming. And I don't want to advocate for them beyond that point, because I'm not sure if I can rely on them doing what they said they were going to do. So don't go dark, don't make them worse. And then the other part is, talk to your loan officer, because, things change in terms of what makes you as acceptable. So talk to them about the important ratios that you should be focusing on. Talk to them about those things that they need to help advocate for you. Ask them those questions. They're there to help you. So make sure that you have that level of a relationship. All right, so let's just recap of what we talked about on how to build a bankable business. One, make sure you have a business plan. And again, one of the services that we provide, we don't write business plans for our clients, but we have a library of about 500 business plans samples that we can provide. So the chances are the business that you're planning to go into or are into, we've got a sample business plan that you can use as a guide or a template to craft your business plan. Now, once you write your business plan, we will help you review it. We will help you get the supporting documentation with market research. We will help you hone and fine-tune your financial projections. And we'll make sure that it's in the format in which most officers are used to see it. Skin in the game. If you don't have skin in the game, or you don't have cash saved up right now, I would start doing research on what it's going to take for you to start your business, and then start planning and strategizing as to how you're going to come up with that equity injection that is going to be needed. So it might be savings. It might be a lot of folks are relying on the generosity of friends and families too. But you have to know that number. Start preparing yourself to be able to come up with that number when you step into the bank to make an application. Look at your credit on a regular basis. Look at it today and see where you are. Again, I'm not going to put out any numbers because they change from time to time, but take a look and see what your credit history is right now. And if there's work that needs to be done, start doing that work right now. Make sure you have accurate and current financial statements. Being able to produce monthly profit and loss statement and balance sheet means the world to a loan officer. If you can say, yeah, let me just run the report and here's this information. Make sure that you, if you have any tax returns that are unfiled, make sure you are filing those tax returns and get those in, because they're at a standstill. If you've been in business and you can't produce your last 2 years tax returns, then there's nothing they can do to help you. And then experience. Start to document your experience. And if there's an industry that is foreign to you, that you've expressed an interest and think that's something that you want to do, one thing I tell folks, it doesn't hurt for you to shadow a person that's already doing that, or to volunteer, or to start at an entry-level position within that industry to gain that experience. Because guess what? At the end of the day, you might decide that this is not something that you want to do. But it's better to know now than to have leveraged, your kids' college savings or the equity that you have in your home, only to find out later that this is not for me. So I would say make sure that you get the experience needed in that. And then finally, build a relationship with lenders. One thing I love about this town, Tallahassee, we've got a lot of good loan officers. We've got a lot of strong financial institutions. And Tallahassee is a small business community. They are really interested in supporting small businesses. So they're, go out and I would say, shop around, call and see if you can go talk to a commercial loan officer just to introduce yourself, find out the products and services that they offer, ask them to tell you, what are their guidelines. And then that puts you in a better position so you're not guessing and you're not applying without knowing what you're looking for. So I would say start early in terms of building relationships. So that is some tips on how to build a bankable business. If you have any questions, just please feel free to give us a call, send us an email. We schedule one-on-one appointments. You can visit our website to schedule a one-on-one appointment. We'd be more than happy to work with you in any regard. So thank you for your time. And are there any questions that I can answer at this time? Yes, sir, Mr. Brown.
How you doing?
I'm doing well.
Always happy to have you in the community and share.
Thank you.
I got a question about one of the points on the list, credit, right?
Mm-hmm.
So, as you know, I had a business many moons ago. Business is tough at times. You find yourself in a credit situation. I work to get myself out of that, right? But because of that, I have kind of a, allergy at times to try to pick up credit. So with that said, credit has risen, but then it just kind of plateaued. And if I'm looking to increase it even more, not just average, not just good, but really kind of work to make it excellent, I have not been doing credit, right? I pretty much, I don't have credit cards and things of that nature, but at some point I'm sure it's time to, kind of get back into that. Right. You all have any credit experts or talk to? I don't want to play it. I want to understand like the specific detail of like what I'm doing and the steps I'm taking, right? Now I know back in the day with Capital One and American Express and all that stuff, you can build business points and all that good stuff, but you get yourself in trouble if you don't watch it. So I like to know the answers before I even take the steps this time around. You know what I'm saying? Who would I talk to in your shop or any of your consultants to make sure that you're taking those?
Yeah, all of our consultants, we have a list of folks who are credit analysts, and if it needs to be, they can help you in terms of repairing your credit and giving you tips and guidelines. One thing about the Business Development Center, we don't directly refer you to just one individual. We're required that we provide three different referrals. So you can just contact us. We can give you a list of those three folks that we have a good track record with and have shown results in working with our clients that may have, may need the assistance to figure out how to increase their credit. But I would say just get a copy of your most credit report and give us a call, and we'd be more than happy to refer you to at least three folks that are here in the community helping small businesses.
I need somebody that really understands that detail because I think my lack of credit, my lack of borrowing and things of that nature now is putting me in a point I can't, where I'm plateaued and can't go further.
I guess we'll definitely be able to help you out in that regard. Yes, sir.
Can you repeat the question for the people online when you take it from the audience and here for us? That'd be
Sure.
helpful. Okay. And then the second thing, I do have an online question for you.
Okay.
I'll give it to you. It is, when building a relationship with the officer, should you send quarterly or yearly reports, or when you have a big lead on a deal?
I would say quarterly. I'm sorry. The question was, when you build a relationship with a lender, should you send in quarterly, yearly, or reports to that loan officer when you're trying to get a larger deal? I would say it would be helpful that you send them on a quarterly basis because that helps them. And in some cases, they require that you update that information on a quarterly basis. I would say at least quarterly. Send them that information and give them a good indication as to how you perform, and also let them know if it was a dip because of seasonality. Provide them that information, that detailed information. Some explanations as to why this past quarter is not looking as good as the previous quarter. But stay in contact with them, and they understand that. I mean, they understand that a lot of businesses are cyclical, but they also want to make sure that you understand and that you were able to make adjustments when your revenue may have taken a dip. But I would say you can never over communicate with loan officers. Any other questions?
Yes. Very good presentation. Thank you. Can you paint a picture of your office or your resources if you know, someone from the public would walk in and go over again who's able to use those services?
Sure. The question was if I could paint a picture of my officers.
They're able to hear it.
Yes,
we're good.
Okay.
Saves some time.
Sure. That's a good question. Physical space. One, we are located downtown, right across the street from Leon High, in the FAMU Foundation buildings, 625 East Tennessee Street. We have and when you walk into the facility, you'll be greeted by a receptionist, and you would inform her of which business consultant you wanted to meet with if you set an appointment. And each of our business consultants have their own offices because we really want to make sure that our clients feel comfortable and there's a sense of confidentiality. And also, we are required to sign, when you sign up as a client, part of that client onboarding is a disclosure about confidentiality. So you don't have to worry about us talking about any of the things that you discuss with your consultant. And then the consultant will start talking to you one-on-one about what your goals and objectives are, what issues and challenges you might be facing. And then that initial consultation will probably last about an hour and a half. And then they work with you to come up with a plan of implementation. So whatever you have expressed as a desired service, they will marshal the resources to make sure that you have that. Our average engagement with our clients, so it's not just a one and done, you come in, we give you what you need, and send you on your way. We don't operate that way. Our average engagement with our clients right now is about 3 years. So we have, ongoing clients. Last time I checked, we've got probably close to 700 active clients. And the average that we spend with our clients each year in terms of consulting face-to-face time is about 12 hours per client each year. So, and that's just face-to-face time. That's not counting the prep that goes into that. So the market research, the building projections, all those things that support you and what you're trying to do is probably, I would say on the average, maybe 20 additional hours per year per client. So it is again, it's customized consulting services. And we've got in the Small Business Development Center, we've got some conference rooms. So if you want to bring in some of your clients and talk, we can make that space available. We've got a computer lab there. So we are equipped and are ready to help.
Thank you. What are the threshold requirements in terms of employees or
There are no thresholds. There are no threshold requirements. You just have to be classified as a small business. And that means that you have less than 100 employees and average revenue of less than $20 million a year. So, yeah.
just under?
You better get in quick. But yeah, we cast a broad net in terms of eligibility for our clients. Yes, you have a question in the back?
Yes, I see that you also provide training and special programs. Do you have business partners that you work with? Or is it provided by the SBDC?
The question is, with our special programs, do we have business partners? We do have business partners. We work with Domi, it's one of our business partners. They refer folks to us, we refer folks to them. We also work with the Office of Economic Vitality. We work with the Jim Moran Institute. We also work with TCC's Workforce Development Program. And we also have a really close relationship with, because we're funded by SBA, so we have a really close relationship with the folks at our North Florida offices based in Jacksonville. In fact, we have they have a person that works in our office third Thursday of every month. So if we have clients that need some specific expertise, they're there to help them with those things such as government contracting, hub zone certification. So all those programs that are administered by SBA, if we have small businesses in our community that want to learn more or get more technical assistance in that regard, we do partner with the Small Business Administration. You're welcome. Any other questions? Well, I really appreciate this opportunity. Please give us a call. Even if you just have some questions, just give us a call. We'll be more than happy to provide answers for you if we can. If we can't, we will help you. We'll go to work to try to find those answers for you. So thank you for your time this morning. Really enjoyed the opportunity to come and share this information with you. And help yourself to donuts. I brought some donuts from Dandy Donuts, so help yourself. Not Dandy, but Donut King. Help yourself.